In the world of property investing, cash and equity are absolute gold. So in today's video, I'm going to help you answer how much equity you actually have in your home or your investment property. And I'm going to break that down to a few questions. Firstly, I'm going to talk about what equity is. Secondly, I'm going to talk about how to work out exactly how much equity you have right now. The third thing I'm going to talk about is, can you use that equity to buy another property? And the fourth thing will be how to use it. And then at the end of the video, I'll talk about another few things that you might not have thought about or may have thought about it in terms of the questions that you should be asking yourself. So equity is very, very simple. Equity is effectively the difference between what the property's worth and what you owe the bank. So let's do a couple of examples. If you owe the bank nothing and your property is worth $200,000, you have 200,000 bucks worth of equity. If you have a property worth $1 million and you owe $800,000 debt on it, effectively you've got 80% LVR there. You've effectively got $200,000 worth of equity, which is the difference between what the property is worth and what the debt on that property is. It's that simple. Now, in terms of working out how much you actually have in the property that you own right now, it's as simple as getting a valuation from the bank on your property. Let's say the valuation comes back in at 500,000 bucks, and then looking at your current bank account or home loan against that property, let's say you owe 250K, and you just literally deduct what the value of the property is versus the debt on the property, and it's that simple. Now, that doesn't matter if it's an investment property or your own home. It doesn't matter if it's in a regional market or a capital city, on the beach or in the bush. Equity is equity Australia-wide. And one thing you need to know about equity at the moment is the banks are being a little bit conservative on these valuations. So if you jump on realestate.com or talk to a couple of agents and go, what's the value of my property? The market value is probably going to be a bit higher than where the banks see it at the moment. That's because, as you know, they're just trying to slow things down a little bit in Australia, which I think has had a really positive effect on Sydney and Melbourne in terms of cooling down the craziness that was going on there a couple of years ago. So the question that I get asked all the time from the investors I speak with is, can I use equity to buy another property? Now, you need to start thinking about equity as the same as cash. Now, some people that we talk with are very, very cash rich, asset poor, which means they've got good savings in the bank, they've got a good job, but they don't have any assets. Other people I speak to, have a good job, and have just been pouring all of their money into their own home or their investment property because they were told that paying off the debt was the best thing to do, which I love that strategy personally. And so they've built up this huge chunk of equity in their property, but they have very, very little savings. So equity and cash can be, I suppose, effectively interchanged. They're both as good as cash. The bank is more than happy to take equity as a deposit to buy a property. They're more than happy to take your cash as a deposit to go buy a property as well. So the answer to that question is absolutely, you can use equity if you have enough of it to go and buy another property. Generally, the way that it works is the bank will look at what your property's worth and what the debt is, and then they will lend you up to somewhere between 80% and 90% of the value of that property. They always want to keep a little bit in the tank there just in case the market goes down in value, or if you're forced to sell that property, they need to be able to recoup the value of that property there. So they always want to keep a safe buffer, and I think as an investor, that's also a best practice to get into. So what I'm saying there is, let's say your property is worth 400 grand, you owed $200,000 on it, you wanted to take it up to an 80% loan to value ratio. So effectively 80% of $400,000 is 320K. You owe 250, so 320 grand minus 250 spits out about $70,000 of available equity. If on another example you were happy to borrow up to 90%, your same 400K property is worth 400 grand, your debt is still 200K, but you're borrowing equity up to a 90% loan to value ratio. Therefore, you're taking it up to about 360K. You minus your 360 you minus your $200,000 debt, sorry, from your 350, which means now you've got $150,000 worth of equity that you can use to go buy another property with. So that takes me into the next part. Let's say you do have some good equity in your property at the moment, and you're in a nice safe position to be able to consider buying something else. How do you actually go out there and use it? The first thing you do is you either go to your bank if you've got a good relationship with your bank manager, or you find a great mortgage broker that can help you go out there and look at all of the different options in the market, and you say, can you please, I'm thinking about buying another property. Based on where I'm at right now, does it look like I could actually afford to do that? And if they say yes, then they order a valuation on the property. They help you, what they call, release the equity, which means take it out of this property and put it into this account so that it's sitting there like cash, and then you can use that cash as your deposit to go buy your next property. And it's effectively that easy. It is such a simple thing. Don't overcomplicate it. Don't overcomplicate it. It's not rocket science, although it sounds like it might be with the way that I'm speaking right now. It's pretty hot in this room. The sun's just gone west and I'm sitting here in beautiful sunny Queensland. So it's cranking in. That's no excuse for what I just did. In terms of another question I commonly get asked is, what effect will using equity as opposed to using cash have on you personally? Now, if I was to go use cash to buy a property, let's say that I was to go buy my $400,000 house and I had $40,000 worth of cash. So I was able to put down a 10% to buy that property. Effectively, after I'd gone through all of the buying, let's say the property was renting out for $400 a week. I take my $400,000 property, I take off my 10% that I've paid, and now I've got a loan to the bank for $360,000 and a rental return of $400 a week. So that's the way that it works with cash. But if I'm using equity, it's a little bit different, because I'm effectively borrowing money back from the bank to put the deposit down. Even if I was to still put down that same 10% deposit of $40K, effectively your $400,000 property, you put down your 10% deposit, which, you know, gives you a position on that property of $360,000 worth of debt, and that's what your bank statement will show, that's what your home loan will show, and you're still getting your $400 a week in rent. But you've got to remember, you've borrowed this $40,000 from the bank over here, and as soon as you use that money to go buy this property over here, you're going to start paying interest on that $40K. So effectively, it's like for every dollar of equity that you use, you are paying interest on that dollar. So in the example of the $400K home, even though you have put down the deposit using equity, you're still paying interest on the whole $400,000 amount, which means you've got a $400,000 debt and still $400 a week of rent. So it can affect your cash flow position a little bit in the short term, and I hope I've made that as clear as possible. I don't think without drawing it up I can show that any better. It does affect your cash flow position a bit, because you're paying debt effectively on 100% of the purchase price, as opposed to, you know, the cash deposit that was taken off the purchase price that you're paying debt on if you're using cash. So there's pros and cons to both options. Obviously, if you can use cash, then that is my preferred method, but I don't always have cash, or sometimes the value of a property I bought in Sydney or Melbourne or Perth or something has gone up faster than the cash I was able to save, and I really want to go buy a property in Brisbane, for example. So I'll use that equity. It'll enable me to move into the right market at the right time, and generally when you're buying at the right time, your gains, the property prices are moving faster than you can save the cash to actually go buy one, which is why people do use equity and why the banks look at equity as something that people in Australia can use. So the last question that I really get commonly asked by investors is, does it matter if my equity is an investment property, in an investment property I own, or my own home that I'm living in? It doesn't matter at all. In fact, sometimes when equity is in an investment property that's already getting a rental return, because it's getting that extra rent return, the bank will actually lend you more of it. So it doesn't matter. I hope this video and my explanation has been good for you. You now understand what equity is, you now understand how it works and how to go and get it, and how to do the calculation on your own investment property or your own home. If you need a hand with any of this stuff, or you are thinking about investing in the property market in the next 12 months, love to offer you a one-on-one strategy session. Please jump over to www.pumpedonproperty.com, where either myself or my brother Simon will have a free strategy session with you. And in that session, we can look at exactly where you are financially, what your goals are for the next 12 months through to 15 to 25 years, what challenges you're currently facing, and what your goals are for this next property you're thinking about buying. And then we can educate you on what's going on in the Australian marketplace right now. My brother and I have helped buy over $300 million now worth of investment property in the Sydney and Brisbane markets. We have an amazing understanding of this stuff, and we can help point you in the right direction. If you want to go and do it on your own, completely cool. We only take on 8 new clients a month. If you'd like a hand to buy that property, more than happy to introduce you to an amazing mortgage broker. My personal one, Aaron, owns over 25 investment properties outright himself. So having, people like him and I on your team, in terms of your team of advisors, to mentor, to coach you, to help you get from where you are to where you want to be, can be a really nice way to do it. So thank you so much for your time and attention. Good luck with your equity. Remember, only invest in property if it's safe to do so and the timing is right for you and the timing is right in the cycle. Don't take unnecessary risks, and make sure you wrap your head around your strategy and what you want to do before you go rushing out and buying anything, particularly in Sydney and Melbourne right now. So thank you for your time and attention. Please subscribe to the YouTube channel if you haven't already done it, where we release heaps of this sort of stuff every week, and good luck.